How does Warren Buffett decide what companies to invest in? What specific things does he look for in a company? You may have thought this was all a secret. Well, it's actually documented in this book, as written by Warren Buffett's daughter-in-law. In this video, I'll actually go through the specifics so you too can learn from the greatest investor of all time. Warren actually reviews all of the points I'm about to cover off together, so it's important that you watch the entire video and note down each of the points I cover off. Very quick disclaimer, I'm not an investment advisor and I'm not advising anyone on investing in any specific companies. Now with that being said, let's get straight into it. Warren's investment philosophy is based on value investing. This is where Warren Buffett buys shares in a company which are priced at a significant discount. Now this discount is based on its share price, but he doesn't just go after any company trading at a discount. He'll only go after specific businesses. These are ones which he describes as holding a durable competitive advantage.
Every time I buy a business, I say to myself, if I had $1 billion and I wanted to go in and compete with these guys, could I knock them off?
Warren looks for businesses which hardly change their core offering. Take Coca-Cola for example, one of his most successful investments. They've hardly changed their main product offering. They can charge higher prices and still sell even more products. Warren realized that the longer you hold these shares, the richer you become. This is because as the years go by, the value of these businesses keep on increasing. To prove this, in 1973, Warren Buffett invested $11 million into the Washington Post. Now this newspaper at the time had a durable competitive advantage, and after 35 years of holding on to his investment had grown to a whopping $1.4 billion. Warren's net worth has continued to compound over the years. This goes to show that his investment principles are just as applicable now as they were before. And Warren decides what companies to invest in after he reads their financial statements. And Warren always starts with the income statement. Warren doesn't just look to see if a business is making profit or not, nor does he purely focus on revenue. He focuses on how consistent the gross profit margins are. Warren looks for consistency in business performance. Coca-Cola had shown Warren Buffett consistent gross profit margins of 60%. Another successful investment he made was in Moody's. This bond rating company showed gross profit margins of over 70%. And as a rule, companies with over a 40% gross profit margin are ones to keep an eye on. But looking at gross profit margins is just scratching the surface. What are the expenses that the business incurs to keep the business running? These are operating expenses. These can be sales, general and admin expenses, or SG&A for short. They can include research and development costs, as well as depreciation. Warren looks to see, as a percentage of gross profit, how much is being spent on operating expenses. Moody's only spends 25% of their gross profit on SG&A expenses. Ford, on the other hand, has gone from spending 89% to a whopping 780% of their gross profit on SG&A expenses. And yes, you're right, that means they are losing a lot of money. Warren only looks to invest in companies who spend no more than 80% of their gross profit on SG&A expenses. Anything below 30% is great for Warren. Some companies do have low SG&A expenses but very high research and development costs. These companies, for example those in hardware, have to aggressively spend on research and development because if they don't, they'll just lose out to their competitors. Warren tends to avoid investing in these companies. Any companies that rely on patents are ones which he avoids too. Their competitive advantage is tied up in their patents. Once their patent expires, so too does their competitive advantage. With Apple as the exception, Warren tends to avoid investing in tech companies. Now pay close attention to this next point. EBITDA stands for earnings before interest, tax, depreciation and amortization. That was a bloody mouthful. Anyway, while many traders focus on this number, Warren actually just disregards it. This is because it makes earnings sound better than they actually are. He believes depreciation to be a real expense that should be factored into earnings. Take Wrigley's, a chewing gum company for example. It has around 7% depreciation. Now compare that with the car manufacturer GM. Their depreciation ranges from 22 to 57% of their gross profit. Next, we need to consider interest expense. This relates to any interest that a company has to pay on the debt that it's borrowed. And once we have the gross profit and we take away operating expenses, we're left with the operating income. The lower the ratio of interest expenses to operating income, the better. Warren disregards any one-off events, also known on the income statement as non-recurring events. An example would be maybe selling a building and earning more money which could add to the earnings. After we pay income tax, we're left with the net earnings. For a given company, Warren looks at the historical trends of net earnings. and these net earnings should be trending upwards as the years go by. The total revenue actually doesn't say a lot about the business, but the higher the percentage of net earnings to total revenue, the better. But there is one important exception to this rule. Banks should not have a very high percentage of net earnings to revenue, because this would indicate that they're taking on more risk. More relaxed lending requirements from banks often lead to short-term gain, but long-term pain. Now if we take the earnings and divide it by the number of shares, we're left with the earnings per share. And when doing historical analysis, you may find that earnings per share doesn't align with the net earnings. Now in theory they should, but companies can take part in share repurchase schemes. Here the company would actually buy its own shares back from existing shareholders, reducing the total number of shares available. Now if there are less shares on the table, it means that the earnings per share has gone up, but here the net earnings haven't actually risen. So with this in mind, Warren will look to see if the EPS has been trending upwards over a 10-year period. Even though it is a snapshot of a moment in time, the balance sheet does tell more than just the net worth of a company. Warren looks for companies which have huge amounts of cash coupled with low levels of debt on the balance sheet. Historically, he looks to see if the inventory has been trending upwards. This shows that the company is finding profitable ways to make sales. More sales mean that the company needs more inventory to keep up with demand. Now here is where Warren really challenges common accounting belief. The current ratio is the current assets divided by the current liabilities. The higher the ratio, the better the company is able to pay off any short-term liabilities. But interestingly enough, companies that have a durable competitive advantage often have a below 1 current ratio, and the most successful companies have billions of dollars hidden from their balance sheet. How exactly, you ask? Well, in the form of brand. The Coca-Cola brand name is worth over $100 billion, but because it was internally created, it doesn't show up as an intangible asset on the balance sheet. This means that billions of dollars were being completely ignored by traditional investors. Well, not Warren, mind you. Occasionally, Warren will invest in companies that have incurred financial difficulty in the past, but he'd look to ensure that all the long-term debt wasn't due in a single period. This could worsen the financial situation of a company. In the last few years, FC Barcelona was a famous example of this. Now let's talk about retained earnings. Now the rate of growth on retained earnings is something that Warren keeps a close eye on. If a company is not making additions to its retained earnings, it's not growing its net worth. Coca-Cola has been growing its retained earnings at 7.5%. Now negative retained earnings can indicate poor business performance, but not always. Some companies are so profitable that they don't want to retain earnings. They instead prefer to pay out all their earnings to shareholders. Now we need to bring up ROE, return on equity. Here, higher is better. The company with a higher ratio is using their shareholders' money to generate more income. Coca-Cola has had ROE in the past of about 30%. Compare that with American Airlines in the past, which has shown just 4%. Warren will dissect the cash flow statement. This is a statement that simply tells us if a company is bringing in more cash than it's spending. If a company achieves this, it's said to have a positive cash flow. The first section in this statement is called the cash flow from operating activities. This shows how much cash the company is bringing in from its operations. Next is the cash flow from investing activities. These relate to cash outgoings like buying machinery or even equipment. They're called capital expenditures and they're expected to last for longer than a year. Warren looks to invest in companies which spend less than 25% of their net earnings on capital expenditure. The third section in the cash flow statement is the cash flow from financing activities. These record the flow of cash, well, related to the financing of the business. Is the company buying or selling its shares? Is the company paying out cash in the form of dividends? This type of information is recorded here. I touched earlier on how earnings per share can be inflated if the company buys back its shares. Warren actually likes to see this trick being used by companies, because it boosts the wealth of shareholders. Even better for the shareholders, they don't have to pay any taxes until they eventually sell their shares. With key numbers across financial statements being scrutinized, he may identify a selection of companies that he could invest in. But you still might be wondering, what about timing? A great business can be overvalued in the market after all. When Warren decides to actually make a decision to buy shares isn't divulged in the book. But the book does emphasize the importance of buying shares during the bear markets as opposed to the bull markets. Even if it's a bear market and the share price isn't as low as previous bear markets, this shouldn't be a deterrent. And as for when to sell, well, Warren looks to hold on to these shares for ideally the rest of his life. Warren previously accumulated $38 billion in capital gains without paying a single dollar in tax. But there are times where companies that once had a durable competitive advantage no longer do so. As per the book, a good time to sell is when the price to earnings ratio is 40 or above. If you're looking to sell, higher is better. Now I know I covered off a lot of accounting terms, so it's completely normal if you want to rewatch the video again. I know some accounting topics can be a bit boring and a tad confusing, but they will be hugely valuable to understand if you do want to learn how to invest from one of the greatest investors of all time. Now if you thought this video was useful, you're going to definitely want to check out this next video. I'm Vas, and if you're still here, you're an absolute legend. Thank you for watching.